Today I'm joined by Randal Jenneke, who is Head of Australian Equities and the Portfolio Manager for the T. Rowe Price Australian Equity SMA. So he and his team are responsible for deciding which stocks to purchase for the MIQ Australian Equity Direct component. Randal, it's been another busy quarter. What have been the highlights for you over the last 3 months or so?
Look, there's been two key developments over the last quarter. So the first one was at the start of the quarter, we had the shutdown in Victoria. And that really kind of, I guess, set a more cautious tone. And then in August, we had August reporting season. And I would say that overall, reporting season was probably a little bit worse than expected. So earnings per share ended up declining for the year by 23%. More importantly, we did start to see some downgrades come through for FY21. But if you kind of looked at the composition, the areas that were, I guess, the bright spots were more on the mining side, and particularly the iron ore names. The negatives were more on the financials and the banks. And I'd say most other parts of the market were kind of swings and roundabouts. What we did see was several companies and parts of the market that were, I guess, more exposed to JobKeeper did better than expected. So that was a really pleasing development.
And so we had the budget recently. Were there any key highlights for you off the back of that?
Look, the key takeaway from the budget is that the government is very focused on jobs and job creation. They're not really focused on budget repair and won't be for quite some time. So if you look at the forecast for the budget going forward, the budget is forecast to be in deficit out to 23-24. And it's highly likely that those budget deficit numbers will probably end up being even bigger than expected. So for next year, the budget deficit is forecast to be about 11% of GDP and then slowly tapering down to call it 4 to 5% of GDP. But really the key focus is all about jobs. And one reason the government feels comfortable to run budget deficits of this magnitude, and these are kind of record levels we haven't seen since wartime, that they feel comfortable because interest rates are very low. So if you look at the negative impact of, I guess, running higher debt levels, it's actually not that big right now, given that interest rates are at record low levels in Australia.
And I think if we think going forward, we've got a few binary events that are coming up. We've got Brexit, we've got the US election, the race for a vaccine. How do you position a portfolio in that environment?
Yeah, I mean, there's a lot going on, isn't there? Look, what I would say is that always think about what's important for markets. And I bring it back to the 3 Ps. And that's profits, it's policy, and it's positioning. So really what the market is looking for, whether it's US election or it's a vaccine, is how do one of those 3 Ps get impacted by that? So when you think about the US election, the key question is how much of a fiscal stimulus are we likely to get? And I think that depends on who wins. If we have a blue wave and the Democrats take control of all of the houses of government in the US, we'll probably get a bigger fiscal stimulus. If we don't have that and the Senate is controlled by the other party that's different to who the president might be, then you don't get as big a stimulus as you might otherwise get. But when I think about the broader backdrop, we do think that fiscal policy is going to play a bigger role. So we think that that probably does mean that the growth outlook starts to improve. That's going to help profits. The key question is, I guess, what happens to inflation and interest rates? And there, just given where debt levels are, both for government and for corporate and consumer, we just don't think that interest rates will be allowed to rise that much. So we still think we're going to be in this environment where rates remain quite low, and therefore we still think that growth assets will be supported.
And so are there's a few scenarios that could play out. Are there parts of the market that you're more focused on getting exposure to for clients?
Yep, so the way to think about it is, whilst growth assets will be supported because rates stay low, growth will improve, right? We will get some stimulus, we will recover from what's happened with the virus. And so we think the more cyclical parts of the market will do better. So we kind of term it cyclical growth. So if you think about companies that have got a good level of underlying structural growth, but they are impacted by a cycle, it might be housing, it might be in employment, those sorts of businesses will do well. So some names there that we own in the portfolio are names like James Hardie, names like Domain, names like Seek. They're all cyclical growth companies that we think will do well in this environment going forward.
Well, thank you, Randal. And thanks very much for your interest in T. Rowe Price.